Everyone checking back in on the market after a week day on Friday, and we're right back down towards our lows, the lowest prices that we've seen in quite some time, 258.62 on SPY, and it looks like we're going to test those this coming week. The financial sector continues to be the anchor on the market, driving force to the downside, and really what we have is a difficult trading environment. And the reason we have a difficult trading environment, if I could make it an analogy, is imagine you have two guys, one guy is the financial sector and the other guy is the tech sector, and they're tied at the waist with a rope. There's enough slack that they can do their own thing to a certain degree, but they're certainly still connected. And when we have clarity in the markets and we're looking for follow through, we have them both going in the same direction, whether it's bullish or bearish. And in the past couple of weeks for the market, we have them playing tug of war almost on a daily basis. And it's consistently with the tech sector trying to see bullish action and bounce, and the financial sector not seeing any kind of bounce. So what we have is a very choppy environment. It's almost like we just get a little bit of a pull to the bull side, a little bit of a tug to the bear side, and that results in choppy action. So for me personally, I slow down trading when that is the case. I put my foot on the brake pedal, and I'm a lot more aggressive as a trader when we have clarity and both sectors going in the same direction. So if you're wondering, should I be aggressively trading or should I be conservatively trading? The answer is, if you're playing these large cap names, what are both sectors doing and are they going in the same direction? So that's the first thing I'm looking for every single morning, is how those two sectors are interacting with each other. So SPY with the weakness, it's all about 258.62 on Monday. If we break that level, we're looking down at the February recovery lows. So 256.73 and 252.39 would be the next levels that we're watching. Again, the bears have absolute control at this point, and until we see the financial sector change the daily trend, which is nowhere near happening, the bears are going to be comfortable. IWM also dropping down to lower lows. Daily chart bounced, formed a lower high at 146.76, dropped down to a lower low. Weekly time frame falling through the October support levels, falling through the February support levels, and here we are back towards levels seen in September 2017. 138.17 is the next support level to be watching. The bears are in full control of the Russell 2000. QQQ. So we can see the financial sector has attempted to bounce. This past week, we had a few green days in a row, some solid follow through. End of the day, or end of the week, I should say, on Friday, certainly giving that back. But that was a bullish attempt, whereas the financial sector, which we're about to look at, didn't have anything like that in terms of a bounce attempt. And that's where the tug of war action was happening. Bounce in the tech sector and further drop every day in the financial sector. So the key support levels for QQQ are 159.41 and 157.13. If we can hold 159.41 on Monday, we'll have the potential of an equilibrium with our low, high of the bounce, higher low, lower high. And if we can form this higher low by holding 159.41, we'll have a really nice tightening range into this coming week. The weekly time frame, exponential resistance rejecting the price, and the November lows are what's on watch. And if they break, back down to the February recovery lows with 155.86 as the first level. So here's the financial sector. It's oversold. We've dumped 10% with no bounce on the daily time frame. We've seen one green day out of the last 8 trading days, and a bounce attempt on a gap down open on Friday resulted in a very weak close. So again, just an example of Friday's trading action. We had a gap down open in the financial sector and a bounce, and then we had the tech sector with a gap down open and a pullback. So we had weakness in the tech sector and a bounce attempt in the financial sector finally. But of course, that dwindled by the end of the day, and the bears had complete control at the end of the day. So here we are in the financial sector hitting oversold RSI on the daily. The weekly time frame is breaking all support levels. The February lows have broken. The October lows have broken. And here we are looking down again back at September 2017. 2382 is the next support level. And what I'm talking about with the daily chart needing to change the trend, even when we bounce, we're just going to look for a lower high to form. So what we need is a bounce, set a lower high, form a higher low, and a higher high. And that's not going to happen for at least a week or maybe even 2 weeks before that pattern can develop. And that's even if a bounce starts. So if a bounce doesn't start and we keep pulling back, we'll certainly be looking for the oversold bounce to get going in the near-term future. But my point is that we are probably a couple weeks away at the earliest from seeing any kind of daily trend change on the financial sector, which is keeping the market bears extremely comfortable. VIX on the daily time frame, higher low established at 2034. That's our new key short-term support. Bulls are trying to make their way back to the double top just under 26. And if we form that lower high and can't break 26. We'll have a tightening range here as well. In the weekly time frame, watching the upper Bollinger Band, which has rejected the price 4 out of the last 5 weeks. So personally for me, it's all about the financial sector and whether or not an oversold bounce can get going, and QQQ, whether or not we can hold this higher low of 159.41. That's going to be key on Monday, and we'll see how it plays out, and we'll see you Monday afternoon. Have a good rest of your weekend. That's that.